Dear colleagues, it's a great pleasure to welcome you to this third Andrew Crockett Memorial Lecture. We all remember Sir Andrew. He has inspired so many of us, and this lecture is the BIS way of honoring his many contributions to central banking and to this institution. And I would like to extend, on behalf of all of us, a particular welcome to Marjorie Crockett, who is with us today. I'm also very pleased. I'm also very pleased to introduce our lecturer, Elaine Ray. Elaine Ray is a professor of economics at the London Business School. She is the recipient of many awards. Let me mention the Bernasser Prize, the Birgit Grodal Award, the Yarrow Johnson Prize, and many others. Elaine's research, as we all know, focuses on international capital flows, exchange rates, and the international monetary system. And we really look forward to her lecture on boom-bust cycles, interest rates, and the global financial system, a topic that we have discussed a few times, and that is certainly of interest to all of us. With that, I would like to ask Elaine Ray to take the podium. Elaine, thank you very much, and we look forward to your presentation.
Thank you very much, Jaime. So it's a very great honor to give the third Andrew Crockett lecture at the Bank of International Settlements. Sir Andrew Crockett made many contributions to improve the interactions between the financial system and the real economy, from the point of view of economic analysis, by fostering more international cooperation, but also by building institutions, such as the Financial Stability Forum, now the Financial Stability Board. In the introduction to the theory and practice of financial stability, which was published in the Princeton International Finance Essays, edited by Peter Kennan in 1997, he reminds us that monetary and financial stability are of central importance to the effective functioning of the market economy. In extreme cases, disruptions in the financial sector can have severe adverse effects on economic activity and even on political structures. This sounds very prescient. In this lecture, I will pursue this line of thought and ask why real rates have been so low and whether this can be linked to the functioning or the dysfunctioning of the global financial system. Along the way, I will talk about the global financial cycle, the Mundellian trilemma, the exorbitant privilege, and the new Triffin dilemma. My philosophy in doing so comes very much from Sir Andrew's view of the world. In finance as in medicine, pathology is a powerful tool to understand physiology. So this is the outline of the lecture for today. I will first discuss some historical evidence on global real rates. We'll then go on to the global financial cycle and link it to the Mundellian trilemma, draw some implications for the international monetary system and the exorbitant privilege, and finish with a policy discussion and maybe some research agenda. All that within 40 minutes. So we all know that global real and nominal rates are low across advanced economies, and levels of economic activity have remained weak across the advanced world. This suggests that the natural interest rate, that is to say, the real interest rate at which the global economy reaches its potential output, has gone down. But understanding for how much longer and the source of a decline of real rates has become a first-order macroeconomic question. In a speech given at the annual research conference of the IMF in 2013, 5 years after Lehman Brothers collapsed, Larry Summers hypothesized that we had entered into an age of secular stagnation, that is to say, an era where output remains chronically below its potential, or equivalently, real rates remain above their natural rate. Thanks to the zeal of a large part of the economic profession, we now have many potential theories explaining the decline in the natural rate of interest. There is little disagreement that this fall reflects increases in desired savings relative to investment at the global level. But views differ concerning the underlying causes of the phenomenon and how persistent it is likely to be. So on the savings side, demographics may have played a role via a slowdown in fertility or an increase in life expectancy, but so could an increase in inequality or an emerging market savings glut. The saving glut's explanation has multiple components. It originates from the combination of low levels of financial development in emerging market economies and rapid economic growth relative to advanced economies. This was the original view of Ben Bernanke back in 2005. Low short-term real rates can also result from an increased demand for safe assets, as per the work of Ricardo Caballero and Fari and co-authors. On the investment side, we may witness a trend decrease in productivity, as described in the work of Bob Gordon for the United States, or maybe a decline in the relative price of investment over time. And finally, another possibility is that the low real rates may be linked to the aftermath of the great financial crisis that we experienced in 2008-2009. And Reinhardt and Grogoff show that severe banking crises weigh on economies for many years. This can happen via a number of channels, from a higher level of government debt to a private debt overhang, limiting both investment and lending by the banking sector. There is an abundant body now of empirical evidence which documents how households, firms, governments simultaneously attempt to delever in order to repair their balance sheet after a major financial shock. Some work by Mian and Soufi. Amir Soufi has delivered the last Andrew Crockett lecture. Low growth post-crisis could also be linked to the reduced efficiency in the allocation of resources during the pre-crisis boom times. There's work by Claudio Borio here along those lines. So in this lecture, I will take a historical perspective to discuss why real rates are low and draw a number of tentative lessons for the global financial system looking at secular data. Now, as usual in economics, when things are very confusing and complex, it's always good to look at history, to go back in time and look at long time series. So this is what I'm going to do. But since we need data extending back to the beginning of the 20th century, I will have to make a selection of countries in order to use this data, because there is little data availability. So to represent the world, randomly, I picked France. But I will also add to my sample the United States, the UK, and Germany, just in case they would matter as well. So the world will therefore be approximated by this group of 4 countries, the G4, who are and have been home to some of the biggest capital markets over the period considered. Now, this first figure shows the short-term real interest rate for the G4 between 1920 and 2011. Very often, when we look at the dynamics of a real rate, we kind of focus on the last bit of the graph. A lot of the graphs you might have seen start in 1980, and then we see indeed that there is a trend decline, which is pretty self-evident there. However, you can see that if we extend backward in time, it is not the first time that real rates have been low. Instead, we can see that in the 70s, they were also low, but even more so in the 1930s, 40s there. So this world, approximated by the group of the G4 countries that we have in front of us, shows us that there are lots of interesting variations over history in terms of fluctuation in the real rate. Now, I'm going to be modeling this world as a closed economy. Despite many recent attempts to increase trade with the outer space, we will still consider that the world could be modeled as a first approximation by these 4 countries as a closed economy in which I'm going to have a very simple law of motion for wealth. So what is going to be the law of motion of wealth for the world? Something extremely intuitive and really just an accounting identity. Imagine the wealth of the world at date t is just equals to the wealth of the world at date t minus 1 minus consumption of the world and multiply by the gross rate of return of the world wealth between date t minus 1 and date t. So it's just an accounting identity, which is the law of motion of the world wealth. If, based on that, I also assume that the average propensity to consume out of wealth is stationary, which seems to be a reasonable assumption, simple algebra, as shown in a paper of mine with Pierre-Olivier Gourincha, written last year, will allow us to derive a very intuitive and fundamental relation relating today's world consumption wealth ratio to the expected sum of a future return on world wealth minus the expected sum of a future consumption growth. This is just literally taking this budget constraint of the world as a closed economy and iterating it forward. So this is nothing else than an accounting identity. Now, of course, this is not causal decomposition. The return on wealth as well as consumption growth are all endogenous and interdependent. So this is, I reiterate, just going to be a consequence of the aggregate budget constraint of the world economy with no additional assumption on preferences or consumption or on anything else. We do rule out the possibility that the world would rule Ponzi scheme. But again, I think this might not be a bad assumption. So to be simple, what this relation will tell us is that by looking at the behavior of the consumption wealth ratio over time, one can expect to gain some insight on the future fluctuations in the return to wealth, which can be further decomposed into the future real rates and also the future risk premiums. Now, using a very simple VAR analysis, as Campbell and Schiller did in their finance work, or Letau and Ludvigson did more recently, the data will tell us which variables are predictable and at which horizon. So let us now turn to the time series of the consumption wealth ratio to these G4 economies, which is this graph. So this blue line here reports the consumption wealth ratio demined for the 4-country aggregate since 1920 up to 2011. So as you can see, we can identify 2 periods during which the consumption wealth ratio was significantly depressed. The first one spans the 1930s, starting around the time of the Great Depression, and ending at the beginning of the 1940s. Not surprisingly, it was in 1939 that Hansen wrote his celebrated paper on secular stagnation. The second period in which we see a depressed consumption wealth ratio starts in the 1990s, and this is after this period again that Larry Summers has revived the idea of secular stagnation. Now you also see that on this graph I've put a third arrow around 2009, where there is a clear coming back of the consumption wealth ratio. And this is in 2009. And most likely, not coincidentally, this is when Jaime started his tenure as general manager of a bank for international settlements. So from an accounting point of view, a low consumption wealth ratio can indicate periods of low consumption growth or period of rapid wealth growth. In both cases, in 1928-29 and then in 2007-2008, the consumption wealth ratio decreased dramatically right before a financial crisis and then rebounded during the crisis. This suggests that the movement in the consumption wealth ratio are driven largely by the dynamics of wealth during boom-bust episodes. During booms, inflated asset valuations lead to very rapid increase in wealth, and therefore in very rapid decrease in the consumption wealth ratio. So you see that in the roaring 20s, and you also see that in the exuberant 2000s, 90s, 2000s. Now, we're going to explore a little bit the dynamics of the consumption wealth ratio using the decomposition that I talked about before, this VR decomposition. And so here it is. So here on this graph, which looks a little bit complicated at first, but is not. So the blue line is still the consumption wealth ratios that I've just shown you. And the other lines are the components of the consumption wealth ratios that we get from these VAR studies. So I just remind you, the consumption wealth ratio today is equal to the expected discounting value of future return on wealth minus the expected discounted value of future consumption growth. So on this graph, what we have put is we have decomposed the expected future return on wealth between a risk-free component, which is going to be in red, and a risk premium component, which is in green. And then we have decomposed the consumption growth component between consumption per capita and population growth, they are in black. And finally, the gray line, which is hovering around the blue line, indicates the fit of the model. It's the predicted consumption wealth ratio. So the results are quite striking. The first thing that we note is that the fit of this very simple model, which I remind you is just based on an accounting identity or a budgetary condition for the world, the fit of this very simple model is able to reproduce quite accurately the annual fluctuation in consumption wealth ratios over almost a century of data. So we see that because the gray line tracks quite closely the blue line. Second, what we can see is that most of the movements in the consumption wealth ratio, the blue line, reflect expected movements in the future risk-free rate, the red line. By contrast, if you look at the excess return, the risk premium, or population growth, or per capita consumption growth, none of these components are economically significant. So all the action here is in the expected future real rate. So it follows that the consumption wealth ratio today contains significant information on future real risk-free rates. Periods of low consumption wealth ratios are periods of rapid asset price increases, and our empirical results indicate that these are followed by extended periods of low or negative real risk-free rates. Moreover, what this graph shows is that we find only weak evidence for the view that productivity growth or demographic forces are key secular drivers of the real risk-free rates, since neither per capita consumption growth nor population growth seem to matter very much. If productivity or demographics were the main drivers of the consumption wealth ratio, we would expect to find significantly negatively correlated contributions of these components. We don't. So taken together, these results suggest that the consumption wealth ratio is driven mostly by the dynamics of wealth during boom-bust episodes. Exuberance drives up asset prices and wealth during boom times. Saving propensities increase in the aftermath of financial crisis as agents attempt to repair their balance sheet. In equilibrium, this needs to be offset by a decline in the real rate. This increase in savings propensity may translate into an increased demand for safe assets. To summarize, what we find is that at any point in time over the last century, the aggregate consumption to wealth ratio contained a great deal of information about future short-term real rates. In effect, we extract here the historical information encoded in households' decisions to consume out of wealth. The consumption to wealth ratio tends to be abnormally low following periods of rapid increases in wealth, as in the roaring 20s or the exuberant 90s, 2000s. And in the subsequent bust, asset prices collapse, financial constraint binds, and households, firms, and governments simultaneously attempt to deleverage. The return on wealth tends to be low or negative, and this low return on wealth is traceable in large part to future low real risk-free rates. Hence, my view is that real rates are low because we have just lived through the largest boom-bust cycle since the Great Depression. Using our model, we can also predict that the short-term real risk-free rates are expected to remain low for an extended period of time. So now I will move to the global cycle and the international monetary system implications. So I just tried to make clear our empirical results do not support the view that low real rates are currently the result of low expected future productivity or demographic forces. Though, to be fair, I didn't provide a completely formal test of these hypotheses. The data are just suggestive of what I just said. Instead, the data point us towards the boom-bust cycle stories, and therefore we view them as very consistent with interpretations of the recent events, emphasizing the importance of the global financial cycle, as in the work of Reinhardt and Rogoff, some of my work, some work of Yoon and co-authors, or some work by Claudio. But what it also means is that we, therefore, certainly need to understand more fully these boom-bust cycle episodes. So what is the global financial cycle? Well, the global financial cycle is the co-movement of gross capital flows, credit growth, risky asset prices, and leverage. It constrains monetary policy independence, including for countries with flexible exchange rates. This is a point that I made in a paper in Jackson Hole back in 2013. And therefore, this transforms the Mundellian trilemma into a dilemma. The trilemma misleads us by assuming that domestic monetary and financial conditions shaping the macroeconomic situation of a country can be conveniently summarized by this one single variable, the short-term interest rate. If that were the case, the extra degree of freedom gained through exchange rate flexibility would indeed be enough to neutralize any effects of foreign financial conditions on the domestic macroeconomy. Yet, in a world of globalized finance, with different types of capital flows and different types of financial market imperfections, key countries' monetary policies affect other countries' monetary conditions in several ways. Financial imbalances may arise, or the presence of foreign financing may lead to powerful balance sheet effects that will alter the transmission channel of domestic monetary policy. In such a world, letting the exchange rate float is not enough to insulate the domestic economy, even for a large country, as global factors are very important. Now, this does not mean that flexible exchange rates have no purpose. They do, and they help external adjustments of countries following large macroeconomic shocks, as emphasized, for example, recently in Opsell and Taylor. But this means that flexible exchange rates cannot insulate economies from the global financial cycle, in particular during the boom phase of a cycle. As analyzed by Yoon, also by Richard Portes, an appreciation of the exchange rate during the boom phase may strengthen capital flows and encourage more lending. Furthermore, as emphasized in 2012 by Jaime Caruana, in his speech on policymaking in an interconnected world, the depreciation of higher yielding currencies tends to happen fast during episodes of stress in global asset markets, and many emerging market economies have found this destabilizing. Again here, Andrew Crockett had it right when he wrote in his 2001 speech that, I quote, "The financial industry is unlike other sectors in that the feedback mechanism from supply to price is less effective or even perverse. In a traditional industry, an expansion in supply puts immediate downward pressure on price, squeezing profit margins, reducing the incentives to invest, and encouraging exit from the industry. In the financial sector, the price that falls when the supply of credit increases is the interest rate. This has the effect of pushing up asset values and appearing to strengthen the balance sheets of borrowers and intermediaries alike. Rising asset values encourage leverage and credit expansion, contributing to further increases in credit growth." End of quote. Of course, the factors triggering the initial expansion of credit may be benign, but it is the mechanism through which excess credit growth takes hold and propagates cross-border that should be much more under scrutiny. In some previous work, I find that the monetary policy of the US is one of the drivers of a global financial cycle. As was mentioned also this morning during the presentation of a research report, the dollar is an important funding currency globally, and mainly financial intermediaries draw on short-term dollar credit and issue floating dollar debt. So US monetary policy has an immediate cash flow effect. Because of the presence on many balance sheets of dollar-denominated assets or dollar-linked assets around the world, US monetary policy affects the net worth of banks, asset managers, households, corporates, and their ability to borrow via collateral effects. International investors appear subject to sharp swings in sentiment. During risk-on periods, financial capital flows across boundaries, leading to increases in risky asset prices and more leverage. This process can reverse sharply during high volatility risk-off periods. US monetary policy is one of the determinants of the fluctuations of aggregate risk aversion in the markets. And Ben Bernanke, in his Mundell-Fleming lecture in 2016, has a further discussion about these issues. Of course, monetary policy may in turn just be accommodating fluctuations in natural rates stemming from underlying structural forces. Now, this led me to discuss the structure of the international monetary system. As one of these underlying structural forces may be the increased demand for reserve assets driving real interest rates down. The country at the center of the international monetary system acts as the world insurer and global liquidity provider. As such, its external balance sheet is remarkable, featuring large amounts of liquid, safe gross external liabilities, such as government bonds, and also on the asset sides, risky assets, mostly foreign direct investment and portfolio equity. So the center country, in this case, the United States, has a large long net position in risky assets and a large short net position in safe liabilities, again, mainly US government bonds. This asymmetric composition of assets and liabilities explains partly the excess return that the US earns on its external position, which is in the order of 2% in real terms per annum. This is what we call the exorbitant privilege. But this exorbitant privilege comes with an exorbitant duty. In times of global stress, the value of the external assets of the US, which are dominated by risky investment, plummets, while the value of the external liabilities, which are the reserve assets, the US government bonds, not only do not go down, but tend to go up. So if you have the value of external assets going down massively and the value of external liabilities going up, what it means is that the US is making a massive wealth transfer to the rest of the world. And we can see that here, where you see the US net foreign asset position at market value. This is going to be the blue line between 1952 and 2016. Now, the first thing to note is that if we were just to cumulate the current accounts, we would get the US net foreign asset position wrong because it would miss the valuation effects. The valuation effects tends to be positive. This is the exorbitant privilege, since the blue line lies above the red line. So the US, in other words, makes higher returns on its external assets than on its external liabilities. Now, what you also see on this graph is that during the height of the financial crisis, between end 2007, beginning of 2009, at the place where I put the big arrow, you see a massive decline in the US net foreign asset position. In this short period, it's about 13% of US GDP in valuation that goes down. And this is one of the periods I was discussing, a time where the US provides insurance to the rest of the world, as during global turmoil, the value of external assets goes down and the value of external liabilities held by the rest of the world goes up. Hence, this massive wealth transfer. And this is what we call the exorbitant duty, which is just the other side of the exorbitant privilege, since it is completely linked to the structure of the external balance sheet of the United States. Now, this period is particularly impressive in terms of the precipitous drop that you can see. However, it is the case that each time we have increase in global volatility, you can see a decline in the value of the US net foreign asset position. And we see it again during the euro area crisis, for example, here. Now, as the center country provides insurance to the rest of the world, its gross liabilities, mostly again these government bonds, which are going to be the safest assets, can be large relative to its own economic size. And when the relative economic size of the insurer goes down compared to the size of the rest of the world, the real rate of interest goes down as the world becomes, on average, more risk-averse. This is also a point that is similar to a recent paper by Bob Hall. So the decline in the world real rate may be the conjugation of two factors, possibly connected: a low-frequency boom-bust cycle and a trend linked to the decrease of the relative size of the US, who is the main issuer of safe assets in the world. Because of that, the net safe asset providers may face a variant of the old Triffin dilemma. The gold value of a dollar is, of course, no longer fixed, but we may still live in a Triffin world. In the 1960s, the source of the problem was a mismatch between the amount of gold held by the US Federal Reserve, which was the backing of the dollar, and the outstanding dollars held abroad. Similarly, these days, there is a growing asymmetry between the fiscal capacity of the United States, which constitutes the backing of the US Treasury bills, and the stock of reserve assets held abroad, in other words, the US gross external debt. Beyond the exchange rate regime, it is the ability to provide liquidity in times of global economic stress that defines the issuer of a reserve currency. The large external balance sheet exposure of the US can generate potentially large valuation losses in the event of a global crisis, as documented previously. As the exposure keeps growing, it could even threaten the fiscal capacity of a safe asset provider or the loss-absorbing capacity of its central bank, leading to a run equilibrium, just like the Triffin dilemma in the 1960s. Of course, to have a run, we need to have assets to run into, and this might be a very big difference compared to the 1960s. To finish, I will discuss some research agenda and start maybe a policy discussion along the issues that I've been raising during this lecture. So the thrust of this lecture is to emphasize the importance of the global financial cycles in fluctuations in real rates and in potentially destabilizing the real economy. One implication is that academic research and modeling should focus a lot more, in my view, on the boom phase of the financial cycles, and not only on the downturns where capital market frictions amplify shocks. Amplification mechanisms have a long tradition in macroeconomics and have been so far the main focus of most of the macrofinance literature. Yet it is essential that we understand what caused the excesses of the roaring 20s and the exuberant 90s, 2000s. And there, I suspect that some type of mispricing of risk plays a fundamental role during boom times, whether due to risk shifting, as in Allen and Gale, or because of behavioral biases, as in Genioli and Schleifer. It is likely that substantial pockets of moral hazard existed and still exist in the financial system via explicit or implicit guarantees or because of opacity. As Andrew Crockett wrote, moral hazard means that risk-taking, which is the essence of financial intermediation, will not be properly priced. I could not agree more, and I'm pursuing precisely this avenue of research in some recent work, where I model intermediaries with different risk-taking abilities and who end up exploiting differentially their option value of defaults. This generates systemic fragility in certain states of the world. Now, from the point of view of policy, we should consider a range of options to weaken the potency of a global financial cycle and increase financial stability. One could, for example, attempt to coordinate monetary policies better, in particular among the large currency areas. Monetary policy coordination and liquidity provision during the crisis have played an important role in averting a second Great Depression, and certainly the central banking community deserves great credit for this. It would be desirable for large currency areas to internalize more the spillovers and spillbacks of their national policies, or even to work on new global rules of the game for the international monetary system, as advocated by Rajan, who gave the first Andrew Crockett lecture. But if history is of any guidance, putting in place effective international cooperation among the main central banks to internalize those spillovers on a more continuous basis, as opposed to in crisis time, still seems out of reach. And there are some good reasons for that. International cooperation on monetary spillovers may conflict with the domestic mandates of central banks. International financial stability and domestic activity may be at odds, at least in the short to medium run. Furthermore, the management of aggregate demand in systematically important economies has important consequences for economic activity in the rest of the world. So trade-offs are complex, and policy action will most likely remain biased towards national priorities. Now, Jaime, in his 2012 speech on policymaking in an interconnected world, nevertheless points towards important steps we could take. He writes, and I quote, "I believe that an international perspective is essential if we are to correctly assess the impact of central bank policies on global outcomes." And he gives the following example. The price dynamics in commodity markets could be taken as a signal of global demand pressure rather than being considered by central banks as a supply shock for each of them. Making progress, Caruana writes, would require central banks to better appreciate, internalize, and share the side effects that arise from individual monetary policies. This will require a shift to a more global analytical approach, one that seeks to factor in collective behavior, interactions, and feedback effects. This would also help us to better frame international cooperation. This seems highly sensible. Other policies to deal with the global financial cycle and the dilemma are to take actions directly aimed at the main source of concerns, which are excessive leverage and credit growth. We could use micro and macroprudential tools and fiscal policy tools in a cyclical fashion to keep credit growth in check during upturns, and favor credit creation during the downturns with a specific attention to the housing market. The countercyclical buffer is an example, but symmetric use requires that the buffer be loaded ex ante. We could also use prudential tools and fiscal tools to decrease structurally the elasticity of credit creation to changes in the cost of funds. Finally, we could also use capital flow management tools to reinforce prudential instruments, either cyclically or structurally. We are already putting in place some of these measures, but enlightened practice will probably require a convex combination of these tools guided by aggressive stress testing. Finally, from a longer-term perspective, this lecture touched upon the stability of the international monetary system and the possibility of being faced by a new Triffin dilemma due to the shrinking of the economic size of the hegemon, the United States, relative to the rest of the world. If that analysis is of merit, then more thoughts should be given to the emergence of a multipolar international monetary system, with China and Europe playing a more important role. This could give further impetus to a number of initiatives aiming at developing euro area safe assets, whether in the form of red-blue bonds, SBs, CDOs. A more multipolar system would increase the supply of reserve assets and be stabilizing. But of course, we cannot rule out that such a system would see an increased likelihood of large portfolio shifts and therefore also larger volatility. To conclude, I will leave the last word to Jaime, who is in address to the 2015 IMF conference on rethinking macroeconomic policy, called upon all of us to keep an eye on global liquidity and to go beyond a strictly national perspective. I quote, "This takes more than just keeping one's own house in order. It will also require contributing to keeping the neighborhood in order. An array of possibilities then presents itself in terms of the depth of international policy cooperation, ranging from extended local rules to new global rules of the game." I agree, and I hope we will be ambitious. Thank you very much.